What's up, everybody? Welcome back to another video. This video, we're going to be working on finding and building a strategy from an academic paper. So, first thing is, first thing I do when I'm looking for an academic paper is I'll just search academic research papers, then, pretty much anywhere where to find one. Then we'll just put in futures trading strategies. So some of them you have to look through a little bit to find one that is you want one that's somewhat recent. So I'd say after 2010, that it's in futures, and also that it's not just trying to predict a trend or how the economy is going to be. You want to predict prices and an actual trading strategy. So the one that I found was this one. So this is the one we are going to do. Now, sometimes, what these websites will do is they'll try and get you to sign up or something, but most of the time the people who publish these don't really care, and you can find the link for the actual paper somewhere. So I went here. No, that wasn't it. Oh, okay, here. Here, then it takes you to another paper, and now you have the PDF. So I just kind of skimmed through it, but if you're doing this to find strategies, you're going to have to be going through these academic papers. You're going to have to go through a lot of them. So most of them, many of them could be, 50 pages. This one says we're at 900 something. No, we're not. Okay, this one's 16 pages from 2012. So, you might not want to read everything. So what we're going to do, copy everything, and I already put it into DeepSeek. We're also going to put it into ChatGPT. We're just going to paste. Hopefully it lets us. And then I like to also put this in at the end. So we want a detailed summary of the strategy, how to execute it, and the probability that it contains any real edge or findings. Okay, too long. Edit in Canvas. All right, we need a new chat. We're gonna, actually, we'll just use the DeepSeek one for now. All right. So thoughts. So this strategy paper outlines a futures trend trading strategy based on short-term chart patterns tested across 40 plus futures contracts. So that is good. You'd like to see that. So it combines technical analysis with risk management and position sizing rules to generate returns. So position sizing, you need to watch out for that, and I'll tell you why later. So, okay. Exit and entry signals unspecified in the text. Okay, well that's not good, because obviously we need that to even trade it. Then roll timing. So that's just rolling over to the next contract, which NinjaTrader does automatically. So we don't care about that. Okay, so here is one of the signals, a confirmation signal. A second consecutive trigger. So 2 days of rising volume open interest to confirm a roll. Well, I don't know what a roll is. All right, position sizing. This is where, so this comes in, right? If we go back to the article, if you come here, right, it's talking about the performance. Okay, here it is. So look, it's claiming that if you risked 1% per trade, if you started in 1990, see where it is. For the risk ratio, however, when stops at 6 million. Okay, so look, I can already tell by just reading this that this is not a well done research paper. So when risking 1% per trade, right, your account balance is almost multiplied by 4. But when you risk 1.25, account balance stops at 6 million US dollars, right? Where that dollars come from. Okay, so we start with initial 1 million. And it was 1.5%, we start at 8 million. Now, the thing with this that can be very tricky is this is completely skewing the backtest. So you never want, if somebody shows you a backtest with risking by percent, you always want to be careful with that because, right, say you start with $100, right, you risk 1% per trade. If you lose the first 50 trades, you're down 50%. Actually, you'd be down close to that. Now, if you let that play out for the next 10 years, right, you won't even be able to see, right? It'd be down here. You won't even be able to see that 50% drawdown. It just looks like you just 8x your money. But if you have huge drawdowns in here, especially with live accounts, is what they'll do is they will have a lot of small live accounts, risk high percentages, so that they build that count, right? Say $100, you build it to 500 here by risking, super heavily risking, and then you lower the risk. And even though you're lowering the risk, it still goes straight up. So just be careful when you see back tests with a chart like this where you're risking by percentage because, right, the amount you win from this trade depends on your very first trade. The percentage you're risking, the percentage you win. So it's very unrealistic because when you start trading, you're not going to start trading here. You're going to start trading here if you put it on a live account. So just keep that in mind. And a good academic paper should be noticing that. So we have a lot of charts on the slippage and on the contracts. I mean, at least they added that. That's good to know. Because a lot of times in trading, right, like 3 ticks of slippage is not 3 ticks of slippage is not super uncommon. So, right, instead of this equity graph, you could have this one or the one down. So, let's see. Next, it talked about, yeah, the risk ratio. Slippage had a significant impact. Okay, so DeepSeek notices the strategy has some merit but faces critical limitations. Okay, this isn't a strength. This is just rolling over. Diversification, that is good. That it works across multiple futures contracts. Risk management, not a strength at all. Okay, yeah. Overfitting with the risk of an exact chart pattern. Also, all those results are in sample, most likely. Okay, so misses a lot of statistical stuff. So according to DeepSeek, it has a 50 to 60% confidence of a real edge. So I didn't think DeepSeek would actually give us that, but I mean, that's good that they gave us a percentage. I like that. So yeah, let's go ahead and test it. Now, personally, I do not think this will be a good strategy, but this video is about showing you how you can take an academic paper and turn that into a strategy. So let's get started. First, we need to find, really all we need is the exit signal and entry signals. Yeah, that's all we need. So here, I'm pretty sure it does have it because I was reading through it a little bit, just skimming it, and it did talk about it. So here we have fractals, which is basically just a fancy name for a pivot, a high, a peak, whatever you want to call it. So the proposed chart pattern basically looks like this. Okay, so this is where it gets. Okay, so it looks like this is the second signal. Okay, so I believe these are the two signals. So continuation pattern is signals that the trend will continue. The proposed chart pattern relates to fractal pattern and chaos theory. Not sure what chaos theory is, but time rather fractal can take a formation is accurate. Uncertainty also increases because no clear rules for stop or market exit orders are present. Maybe therefore. Okay, so right now it's taking fractal strategy from Williams, which I think is the same guy that makes all those famous indicators. So these shortest together with a lack of fractal signal strength measurement constitute inaccuracies when trying to build a computerized trading system. It's the easiest way to overcome this problem is to do backtest analysis full of pre-select particular contract, but such a way makes quantitative analysis limited and equal to average and financial behavior of the market. Generalizing. Okay, so it's saying we're going to take fractals, but that's not everything. So we need to find more. So this is where it starts. So the proposed short-term chart pattern is composed from 3 consecutive chart bars and uses only the latest data for decision making. Highest high in the middle and one lower high on each side. That's going to be seen in some figures, in some examples in figure 2. Okay, so this is our fractal right here. We'll go ahead and paste this. So the fractal is going to be this candle, right? These are all candles. So the trading strategy opens a long position when current price tops the second bar's highest price. Open price is set at the second bar's high level plus a tick size. Tick size is a minimal price increment. Each contract has a different copy of the other contract. Tick size, blah 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 blah. If current bar price opens higher than the last bar, and forms a gap, a buy signal is identified as an opening price. So not sure what the heck they're talking about when they say identified as an opening price. Finding the appropriate time to close the position is just as important as determining the best time to open it. Shows that the trading order should be set at the level of the second bar's lowest price minus the tick size. Okay, so here is our exit strategy. So our exit strategy trailing almost at low of previous candle for a buy. Adjusted, move to the next bar lowest price each time the new. Okay, so it's not actual trailing, it's a actually it is a trailing, it's just not a built-in trailing that NinjaTrader is going to have. So trail stop loss to low of previous bar as each new bar is printed. All right. This has profit runs. This lets profit run and cut losses in response to the market price changes. Blah 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 blah. Okay, so we need to figure out what this signal is. Opens a long position when the current price tops the second bar's highest price. Yeah, I mean, this is a pretty terrible research paper because the current price is saying it's I, but I is an index for the current bar, so yeah, whatever. Tops the second bar's highest price. Open price is set as the second bar's high level plus a tick size. So if current price bar opens higher than I from the gap, a buy signal is identified as an opening price. So that doesn't really make much sense to me, but from here we can definitely take something, I think. So looks like first we need to have a peak. So that's going to be a low, and the two candles to the left and to the right are both going to be higher, right? So then we have our middle candle is that peak. Then once we have our two to the right newer bars that are higher, so going up, then if we go above the high, then that's when we buy and set a stop loss at the low. So yeah, basically from what I believe, it means we're going to need a candle, candle, candle. This is our fractal. And we're going to go, then we need two more candles, right? So now we have our fractals confirmed on this candle. Now as we get our new candle, we are going to buy if price gets above here. So basically we'll set a buy stop order there, and then we would set the trailing stop loss here. Now, as this candle forms, right, say it forms like this, we're now in a buy right here. As the next candle is printed, now our stop loss is moved from here to here, and so on, there, and so on, until we get a candle like this that comes down and hits our stop loss. So that is definitely, we can definitely put into the strategy. Next signal the market's research results can often be predetermined in advance by taking only a particular contract or the most suitable time period for analysis. In order to avoid such subjectivity when doing quantitative analysis, research must be considered. If a futures contract with the biggest 2 days price increase, where the lowest price of the last bar is higher than the one a month ago. Lowest price of the last bar, lowest price of the period I is greater than the lowest price of the period I minus 20. R means the rank of a person. C, the closing price of the period I. The biggest increase in price of a particular contract during the period between best quality and the highest rank. If the chart pattern is moved on several contracts. Okay. Okay, so what it's saying is many contracts, instruments, can have a signal at the same time. So this is how they rank the strength of the signal. This is actually something I've never thought about, and I like it. So what we're going to do is this is what it does. All right, so we still have this entry signal, but to get the rank, we are going to take C. What is C? The close? Yes, C is the close. So we're going to take the close of I minus 2. So I minus 2, right, if we... Right, this is minus 2, minus 3, minus 4, which would be minus 4, minus 3, minus 2. Right, so this is our entry candle. Actually, it should be minus 1. Yeah, that's pretty confusing, their chart patterns. But what it's doing is it's going to take, for the ranking, we're going to take the close of this candle, right? So let's say it's 100. This can be 95, 90. Then we're going to take, so times 2, so that's going to be 200 over the close of I minus 4, which is this candle. This candle closed at 90 equals, well, and then minus 100. So what's that? 2.2 2 and 2/7. What's that in decimals? No, 2 divided by 9. What am I saying? 200 divided by 90. That's 2.22222 minus 100. So this ranking would be negative 97.7 repeating. Now, right, say candle I3 was much larger. So it's something like this, right? Close at 90. But then I2 closes at 150. Now we're going to get 300 divided by 90 minus 100. And that gives us negative 96.6 repeating. So higher. So we would take this one over the other one. So basically it's saying candlestick patterns with more momentum are the ones we're going to focus on. So we can also, so what we can do in our NinjaTrader strategy is code that in so that we have a minimum, right? So you could say if R is less than, right, negative 95, then we don't trade. And so we'll only trade if R is greater than negative 95. But then we can also test if it's greater than negative 98. We can test if it's negative 90. So you can test different stuff to see what makes it best. So we've gone through the research paper. We now have the strategy. At least I think it's the strategy they were using. Now let's actually code it. So let's go here. You're going to go new NinjaScript editor. Give that a second to load. New strategy. We're going to do to trend academic paper. Next input parameters, holder, that just helps us later. So then generate. Now we have our basic strategy and the template for it. All right, so now let's go ahead and code the actual strategy. So first thing we need to do is find a peak, right? We need to find when this happens. So to do that, this is what we're going to do. So first, if current bars less than bars required to trade, then we return. So now we need to start calculating if there is a peak. So what we're going to do is if so we're going to take the if we're entering on this bar, we're taking the low or the close of the last 1, 2, 3 bars. So in these examples, okay, so this is supposed to be a bar. I don't really understand how it's buying here. It buys here. Yeah, I don't understand that. Okay, but for ours, what we're gonna do is if we have a low, then we need to check for 2 candles before it, 2 candles after it, and right when this happens, this pattern happens, then we're going to say new candle forms. This is all there is so far. The first tick of the new candle. We're going to set a buy stop here, and the stop loss will be here. And so as this candle, does its thing, might hit it, might come down, then hit it later. And then we'll also, no, for now we'll only leave it 1 candle, and then if it enters, then it'll go. But if it doesn't enter, it'll cancel the order because that's the default. That's the Ninja Trader default. So first thing we're gonna do is we're gonna iterate through 5 bars. We're gonna iterate. So this is gonna be, so if we take close 0, that's the bar of this price. Or we could do I. Then this candle is gonna be close I minus 1. Then close minus 2, minus 3, minus 4, and minus 5. So what we need to do is iterate through 5 candles. So we're going to do for int I, I is less than 5, then we add 1. So this is just a basic for loop. It's saying, for, then we're setting a variable I. If I is less than 5, then we're going to execute whatever code is in here, and then after all that, we're going to add 1 to I each time. So this will loop through 5 times. So what we need to do is we need to make sure that I minus that the third candle back is the lowest of the last 5. So how are we going to code that? So if low I okay, so we're going to do no, I'm doing this wrong. What we're going to do is if lowest bar, we're going to get the lows of the last 5 candles. If this equals 3, then we have a signal, So what this is taking, this is going to give us the index of the candle with the lowest low. So in this case, it's going to take the last 5 bars, which is going to be these, and give us the low. So here, this is the lowest, and it's 3 candles back. So in this case, it'll be true. Now, say we have this, if we check right here, the lowest candle is 2 candles back, so it won't be true, and it'll wait for 1 more candle. So if this occurs, then we're going to set enter stop. Why isn't it showing up? Enter long stop market. Yeah, that's it. At the high of one candle back. Then we're going to set stop loss calculation mode dot price, and we're going to set it to the low one candle back. Now, from this, we should start to get some trades. Change lows to low. All right, from this, we should start to get some trades. We're going to do new chart in queue, do the 60 minutes. We need more. How do I have more days to load? Days to load. All right. We're going to load up a strategy. Academic paper. Enable it. And apply. All right. And there we got it. Now, all right, so a couple things. One is we only want to do this if we're in a flat position. Because, for example, here, right, it moves our, because we got another low, it moved our stop loss to the low of the last candle, which we're actually going to do anyway, but we just want to make sure we're not entering and moving stop losses when we don't want to. Let's also, every time we get this, let's draw. Oh. So I added this, and also we're going to draw vertical line and then when you draw things, if you give them the same name, every time it draws a new one, it's actually going to delete the old one and just keep the new one. So what we're going to do is so that we can leave all the lines, we're going to do this. We're going to do line and then current bar. Then it's going to be at time 0 and brushes dot blue. All right, let's compile that and see what that changes. All right. So now, every time we're getting our entry signal, there's a blue line. But as you can tell, the times it's not executing, see here it should have. Okay, but besides this one, where did it go? Which this one, which is because I'm guessing, right? After this candle printed, we would have put the stop order right here, which price was already there. So I'm guessing it got canceled because you can't put it above, or you can't put a stop order below the market price. So yeah, it looks good. Now we want to do this for the short side. Actually, this video is already very long, but in the next video, we're going to do this for the short side. We're going to set up our trailing stop loss and create the kind of rating and optimize a rating threshold. And then after that, it should be almost identical to the strategy in the academic paper. But yeah, that's it for this video. If you found it valuable at all, please like and subscribe. If you want this code, I'm going to leave a link in the description. You just fill out a quick little survey, and then I'll send you the open source code for this so that you can try it out for yourself. Obviously, this one is pretty simple, but in the next one, you can get that one as well. So yeah, that's it for this video. Thanks for watching. Peace.